Hello guys, today is Friday, February 28th, the last trading day of February, and it's time to assess our portfolio and the market itself. So, about market, we are hovering around the bottom after 5 straight days market decline from the top. And the most important, VIX is very high right now. It's approximately 21.5, right on top of the range. And if we talk about February as a month, it's down month. We don't have too many of them usually. And we're down about 3%. And if we count it from January 1st, for 2 months, we're approximately 1% up. So it's not bad, because if we compare market condition compared to uh, first day of the year, the market is much lower, and the most important, VIX is much higher. It's approximately 5 points higher than it was on January 1st. But good news that all our potential profit are sitting in this elevated volatility, and as soon as market bounce up, or if not, we will get that profit some way or another from theta. So yes, we did a couple of adjustments today, and most of our naked puts right now at very safe distance, around 10-12 delta, which is not bad, especially in this high volatility environment. Delta 10 is pretty far away from the market itself. So let's see how our portfolio look like now. So this is our total ES futures position. After today's roll, you can see it's kind of safe, and also you can see that red line, it's just in 2 weeks we see there more than $20,000 sitting right now in our short puts, which I hope we're gonna get some way or another. Let's see our separate trades. First, we will start with Balalaika. By the way, it wasn't rolled yet, and probably if we're not going higher, next week, at the beginning of next week, we have to roll it. So right now, just 21 days left till our closest short puts, and it is at delta 17. And another one is 35 days till expiration, and it is at delta 19. But good news, we have lots of hedges here, so as soon as we need to roll it, we will use some of them to pay for that roll. But this is how that trade look like now. So you can see that it's not bad. What else we have here? Let's talk about our income positions. We did roll today income 1 and income 2. So this one is income 3, which we didn't roll. It's 31 days till expiration, and delta at 13. The income 1 is right now at delta 12. We did roll today. And our income 2 is Also we did a roll, right now it's at delta 12. If we check it together with our CDH positions, we'll see how it look like. It's just with CDHs. Also we have some leftovers from our A, B, and C ladder. By the way, some of them we closed today with good profit, so it will disappear from the graph. But remaining is, this is how it shows with our remaining hedges. Total delta is pretty high, it's 21, or weighted to SPY it's about 210, but theta is pretty big, 300, more than 300. So this is how it look like. What else do we have? We have let's talk about our violin position. We have V8, pretty old one. Also it's approaching to zero after this huge market decline. But we're safe here because delta, our short puts only 21 days till expiration, and it's only at 11.5 delta, so it's pretty far, and I hope we're gonna get this soon, and probably end of next week we're gonna close that position completely, and I guess it's gonna be a profit. V9, it's low, just 22 days in that position, and today it went below zero, approximately $400 minus. Our short puts at 35 DTE and at delta 16. So if it will be at delta 20, we will do what we should do. We will roll it down and get some credit from our hedge. But it's not bad also. We know what we're gonna do. Also, if you remember, we started a couple of weeks ago new strategy, Kazoo. We already closed the first one with good profit. Now Kazoo 2, 3, and new one 4. Let's see each of them. This is Kazoo 2. It's still in small profit after this market decline. And we have 28 days till expiration, and delta is 17.6. If you remember this strategy, we don't do any rolls. If we get delta 20, we probably next day, I don't like to do it exactly when our triggered deltas breached. Probably next day, if market won't bounce up, we will close that position and right away open the new one. So this is big Kazoo 2. It's approximately in small profit about $100 and delta 17. Kazoo 3 is at small loss right now, approximately little bit less than $200. Let's see where is our short puts. It's 42 days till expiration and a delta 15.5. And Kazoo 4, which we just opened a couple of days ago. Yes, exactly 2 days ago. Because it's new and we opened it right before market decline, it has a bigger loss, approximately $700. But I don't see much risk here. We have delta approximately 14.5. Also, we have Kazoo strategy for small accounts, which is only one short and one long. Kazoo 2 small is a small loss, approximately $300. the same 28 days till expiration short put at delta 17.5. Kazoo small 3 is a little bit bigger loss, approximately $200, not a big deal. And at delta 15.5, 42 days till expiration, and Kazoo 4 small one, which we opened 2 days ago. Right now it's about $180 down, and 61 days till expiration, and shorts about delta 14. Also, we opened today just to create the new delta hedge for free. We open Violin Mini. How we do that? We open delta hedge and sell just one naked put, 30 DTE, to offset price of that delta hedge. So we have two choices here. If market go up and our 30 DTE short put will expire, or we will close it at 80% profit, we will get free long-term delta hedge, which is gonna provide us additional protection for our portfolio. If market decline and our short put will reach delta 20, we will convert that structure to regular violin by rolling that short put to 60 DTE and increase it by 2. So it's gonna be very safe, good violin strategy. So it's kind of win-win situation. This is why we open it. And right now, we did it yesterday, by the way, 1 day in market, and just before yesterday market collapse. So it shows small, about 400, it's not small, $460 in loss right now. And also we have one left ladder D, which we did roll today too. This is how it's look like. We did roll this one. Yes, right now it's at delta 13.9. It's reached delta 20, so we did roll and pay for that by closing one of our vertical hedges. So now it's a pretty safe distance. I hope it is safe, because usually in high volatility environment, delta 13 and 14, it's pretty far. It's strike 5,400. So that's it for ES positions. We also have our wheel with micro ES options position, and we also did roll today. So if you remember, we have two expirations, one of them M4, which just 21 days left. We reach and exceed the tail profit here, but I still would like to hold it because it has small negative delta. Worst case scenario, we will get our tail profit, but if market decline, we can get more and compensate some losses from another expiration. Another expiration, MES 5, which is 61 days till expiration. Right now it shows loss approximately $220. And we did today adjustment. Just would like to remind that OptionNet Explorer doesn't have MES options, so we have to track it in regular ES. As a regular ES position, we just need to divide it by 10, so it shows loss 2,250, but real loss it's $225. So what we did today, we got the highest hour shorts, which was this one, 5,550 strike at delta 19.8 right now. We roll two of them to 53.75 strike and increase it by one. So we virtually did it with zero cost, 2 by 3. So right now we have most of them. One of them at delta 16, another one at delta 13. But don't forget that we have two longs which well protected us. One of them already pretty close to at the money. So probably next our adjustment, if we need it, we will do by rolling down that long to take profit and use that credit or profit to finance our next roll down of our short puts. Also, we have our TLT position, nothing, no problem here. We are in very good profit here. What we have the closest expiration 21 days. So we have a naked put which is right at the money right now, and at the same time we have a same at the money short calls. So we will wait till they will expire, and if one of them will be in the money, we will just roll it out and sell another options against it. So our position right now shows pretty good profit, about 1,000. This is how it's look like, and we will continue to do the same thing. By the way, if you remember, we just started a couple of days ago some positions with stock options, which we're gonna use approximately the same kind of strategy which we use for TLT position. And I wouldn't like to show it today here because it's nothing to show. It's just a couple of days, and position is approximately at zero, maybe very small negative number just because of increase volatility. Couple of days, and maybe next week we start discussing it. And I promise you to make a course about how I trade my stocks with options. I plan to do it this weekend. I hope I will finish it and will introduce you beginning of next week. Also, we have the last one, CL oil futures position. It is approximately at a zero. After oil decline, it's right now around 70. So not bad. It's pretty safe because our short puts is at delta 11.3, 58 strike. It's far away. But again, if oil will collapse, we will do the same thing which we did today with our mass adjustment. We will close 2 of 3 of short puts and open new 3 positions below. We will try it at zero cost. This way we will widen our profitability tent and reduce delta, and we will see how it will perform after that. I don't expect that oil collapse so much, so it's gonna be, should be again profitable trade. So far we didn't have any of losing trades in oil position when we traded this kind of strategy. That's it about portfolio, about market. Let's talk about questions. You have some of them. Let me find them. Questions for next video. Okay, from Peter. Questions for the next video. With all the strategies here in Discord from you and others, how would you recommend we test and evaluate them for ourselves using tools such as OptionNet Explorer? If possible, please give a step-by-step overview of how you would do this. Thanks. Well, it's pretty simple. OptionNet Explorer, pretty good tool for testing it. Just one hint: I don't recommend you to test it using ES futures data, just because OptionNet Explorer database doesn't have reliable data for futures. Use SPX data. It's the same thing, you just need divided by 2 because SPX options 2 times bigger than options of ES futures. How I do that? Right way to test any strategy, to test them in different market environments. So if you go, let me try to show you. If we go to ES, click on the price chart, and you can scale it down to see it, and you can choose different market condition. For example, when market is going down, you can pick a date, for example June 18, 2023, and open that position in OptionNet Explorer, and day by day see how it's behave during this market environment. If you would like to check it in up market, you can pick any of days of this long leg and do the same thing. This is how I do that. It's pretty simple. I wouldn't like to show anything else. It's you can do the same thing with OptionNet Explorer. I don't use any other tools, so I cannot tell you how to use other tools. How I understand, just OptionNet Explorer allow you, like in real time, to do adjustments. Other tools is not allowing you to do adjustments, so you can test just strategy which could be just open and closed without any changes, which is not the right way to test our strategies, because our strategies has some adjustments. We know when and how we do our adjustments, and better to test it in OptionNet Explorer. Okay, second question. Do small account have any approach to do something like diagonal ratio hedge? So in chat there are some experienced traders do it like a short DTE with 1-to-2 ratio. What do you think of any? Any advice if delta is over 0.3 or 0.4% and we need this? Unfortunately, I have bad news for you. Diagonal ratio hedge, which we use, is a very, very good tool to reduce your portfolio delta, but it is for big account only. I don't recommend you to do it in small account unless you can try to do it in MES options. But we know that MES options, especially long-term expirations, don't have pretty good liquidity. But you still can try it. But with ES, I don't recommend you to do that. About ratios, short term, it's a very good question. Yes, you can use ratios, but short term hedges, not just ratio, any of them, have one pretty big problem. I explain you. Yes, if we compare two hedges which is at the same deltas, short term and long term, and during market decline, definitely short term hedge will perform better than long term. No question about that, because of higher gamma. But what is the problem? Problem is that any hedge is effective only when we open it at very low volatility environment. So that means that you can continuously open short-term hedges like ratio hedges when volatility is small, but it is just one time using hedge. Why? Because if market collapse, yes, you can use that hedge, get some profit from it, and use it to adjust your strategies. But if market continue to go down and volatility is increased, you can't open new this kind of hedges anymore. Well, you can, but it won't be effective. I'm pretty sure that in high volatility environment, even if market continue to go down, your hedge will not perform. You're probably gonna lose money from it. This is why the only way which I found is very successful for portfolio managing is continuously to open at low volatility environment long-term hedges. Why? Because when volatility is low, unfortunately, we don't know how long that market will stay in that condition. Sometimes it's pretty long. And if we open at 120, 140, 150 DTE hedges in very small IV, we have lots of time that these hedges will play out. And this way we can build the wall of the hedges, and this way we have the first, the second line of defense, even third line of defense hedges, just to do it long term. By the way, we have one hedge which can be open in higher IV environment, and this hedge is one of my favorite. It's our delta hedge. Yes, it is not as efficient as a vertical hedge, but we can open it virtually for free. And I continuously do it all the time. If I go long term up to 200 days till expiration, I am trying all the time to add some delta hedges there for virtually zero cost and accumulate them. So we have to, when volatility is small, try to build the walls around our naked puts. Why? Because at that time, that walls are much cheaper, and it can serve us very well during big market decline. This is how I do that. We already discussed it in Discord, but if you need details about how I open long-term delta hedges, you can ask in Discord. We will discuss it a little bit in more details. Question number 3. I broke a violin string today, sold one long to pay for unrelated income trade. How would you repair the violin hedge, or would you at all? That's a question from Tom. Listen, Tom, I trying for at least for last 6 months to show you that virtually it doesn't matter which hedge related to which strategy. You have to evaluate and think about total your portfolio. So that's mean that it doesn't matter did you broke your violin string or not. Well, we will, if market bounce up, definitely you should look how to repair that violin strategy. But I think it's gonna be okay, because if your violin short puts is pretty far, I hope that it will be in profit and you can just close everything altogether. So don't worry about that. That's it, guys. Thank you very much. I don't have any more questions. Again, we will see how March will play out. I hope that, because our lots of our profit sitting right now in inflated IV of our naked puts, plus all of them at pretty safe distance from the market. Hope that we will get that very soon, and I expecting that March will be way better than February, maybe some like a January, about 3-4% at least. Thank you very much. Have a good weekend, good night, and don't worry, just enjoy your life. Thank you. Bye bye.